Hello, everyone, and welcome to Leading Indicator, a show by Public.com focused on gaining insight from the world's best macro minds. I'm your host, Anne Berry, and today we are breaking down the Fed's July meeting minutes and the risks presented to markets regarding the possibility of further rate hikes. Don't forget, folks, to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help you keep up with the latest investment news. Today, excited to welcome Samantha LaDuc, founder of LaDuc Trading. Samantha, welcome to Public. Great to have you on with us today.
Thank you so much.
So while we have central bankers gathering in Jackson Hole, Samantha, let's unpack together the July FOMC minutes recently released and showed that the consensus may be that further rate hikes could be necessary, inflation perhaps persisting a little bit more than the market had thought before these minutes were released for general consumption. Talk to us a little bit on your key takeaways from what the FOMC minutes had to say.
Well, in a nutshell, I think they're going to pause, and I think they are a little indecision amongst the ranks as to how to get control of this inflation that they have yet to control. So in a nutshell, I think that the Fed is trapped. So we have very sticky inflation, more specifically, very strong wage inflation that has helped delay recession. But it is the reason for the season why companies have been able to continue to pass on higher prices. Mm-hmm. Wages continue to move higher. There's a United Auto Workers vote this week. We've had UPS and others have to negotiate much higher wages. Prevailing wage, local living wage for cities. The theme is very clear. Wage inflation has helped delay recession. And the Fed is obviously aware that this could become a problem. In other words, a wage inflation spiral narrative. But we're not there yet. So as it relates to that kind of whole indecision with amongst the Fed heads, some are really kind of intonating now that perhaps that goalpost, the peak terminal rate, should move higher. That would be very disruptive to markets. We've already seen bond volatility stay very elevated and higher still since the FOMC minutes. And I think right now the 10-year is basically running into the Jackson Hole Powell speech Friday morning. But we have more at risk. So we have a market that has, succumbed to some gentle pullback, only 5% in the past 3 weeks. But we have NVIDIA earnings after hours on Wednesday, and there's a sentiment tell there for sure. And then we have the BRICS conference this week, which is, of course, driving a lot of commentary around de-dollarization. We have Jackson Hole. We have the United Auto Workers.
A lot going on.
We got a lot going on. So it's not just one thing. It's not just one thing.
It's not just this one thing. But I just want to push you on something you just said, Samantha. You literally just listed a whole host of factors that may point to inflation being a little bit, to borrow a Fed phrase, higher for longer. You pointed to wage inflation. You've pointed explicitly, you said stickiness. So why, to go back to your opening statement, do you think there's going to be a pause in Fed rate movements, given everything you just said?
Yeah, I think they're stuck. So as it relates to inflation moving higher, that's not the only issue underpinned by wage inflation, but also rates continue to move higher as our debt burden, in other words, the interest on U.S. government debt approaching $1 trillion, more than the defense budget. This becomes a self-fulfilling prophecy for where bond holders and others require higher risk premiums for their money. So it actually underpins higher interest rates. So regardless, the Fed doesn't have to do anything. In other words, rates are continuing to percolate higher and for longer. So this is something where the Fed doesn't need to hike. They basically are, I believe, going to be into kind of a pause mode, and then next year try to pivot. It won't work. Fed is still trapped.
What is your outlook? What's your house view right now on where the indexes are going to end the year?
So back in July, I actually felt that we would tap out about 45.65 or 46.60 would be the peak for the year.
Right.
So we hit that 4,600 and started to roll over, but it was very, very important what triggered it. The Treasury announced on July 31st their bond issuance, and it was massive.
Yeah.
So this is most important as it relates to the bond sentiment. And I don't know if you've noticed, but yields have continued higher and bonds lower very, very strongly since this August 1st kind of revelation. So underneath the surface, we have seen breadth break down. It was solid from June and July. It was a beautiful rally in value. We had junior tech. We had dash for trash in the hedge fund factor rotation, which is basically short covering. So we had a very robust move. In addition to NVIDIA, which was the AI speculation.
Yeah, we'll come back to NVIDIA. Yeah,
everything changed when that July 31st Treasury issuance was announced, which showed very clearly that there is an oversupply of this bond issuance that is going to put more pressure on the long end, and it has created the headwind for equities. So slowly but surely, August 1st, right through, till today, we've had breadth destruction and net selling over net buying. So long story short, the equities were priced to perfection back in the end of July. The issuance numbers came out, the FOMC minutes as well. But now the fact that we've pulled back, I believe we're going to have a dance, which means we kind of pull back, we bounce, we pull back a little bit more, we bounce, we pull all the way down to 4,000 is my bet at the end of September. So I made that call very audible back in mid-July. I was waiting for the turn. We've got the turn. I don't think it's going to be anything like a 1987 drop. No, I don't play that game. But it is absolutely a market that was priced to perfection, both in their earnings as well as this strong economic backdrop of GDP, increasing while headline inflation has been decelerating since June of 2022 to June of 2023. So we went from 9.1, and then we finally broke that handle, that 5 handle. So we're in the upper 4s. So the headline CPI is what has been very, very supportive.
Go back to the question, Samantha. So S&P 500 ended this year. Originally, you had it pegged at 4,500. You're now calling that it's going to go down to 4,000 September. Where do you still think it's a 4,500 by the end of this year? What's your number for the S&P for 12th April?
I actually never gave a number for 4,500 of this year. I gave a number last year, which actually did in fact trigger, which was fabulous. And then in January of this year, I said, I don't know. I see unattractive risk reward. I see a level where if and when we close below 3,600, the market will not recover for probably a few years. But then we had this bank bailout in March. So just remember, I'm a sector rotation specialist. So I'm like watching where money's flowing. And when March came around, after this mega cap concentration risk was so outsized from January, that literally lit equities and gave this very nice foundation for speculation in NVIDIA and the rest. Long story short, loose monetary policy is very beneficial for equities. And we had a very nice move from March 12th, literally, when the White House, the Fed, and the Treasury all came together.
So Samantha, I'm hearing no prediction for this year. Is that right? Do you have a number for the end
I
of the
see
year?
4,000 for September 30th, and then we'll see. I actually think that'll get bid, but I don't have a December 31st, 2023 price target.
Got it.
Unlike I did last year, I had a very specific one.
Got it. The crystal ball is always tough, but let's go back to NVIDIA. We have seen that name is up, I think, it's a triple in this year alone. It's up over 110% in the last 6 months. I will confess, I read the ARM F1. I read that full document today. That business is spec'd to go public as early as next month. So artificial intelligence is top of mind. Rates are still going to be higher for longer. These growth names have been sensitive to a point to what rates are doing. So where are you right now, Samantha, real quick, on where high-flying growth stocks are going to go? You've pegged 4,000 through September, but the S&P 500, as we know, it's got the Magnificent Seven pulling a lot in there, but we've got other sectors in there. Where are you specifically on growth stocks?
I am very specifically excited that we have a growth to value rotation that has started June 1st. It takes a while. So we start to have mega cap tech and growth peter out before they start to roll over. Value stops going down. Cyclical, defensive, we are coming up. But the point is they actually have this very nice support from June 1st. We had a very strong 2-month rally, and then August, a pullback of size for value, no question. But the point is, this is a very strong theme into the end of the year. So I do not put a lot of weight on NVIDIA being sustainable up here, let alone the ARM IPO. I think they're more than priced to perfection, borderline, way ahead of their skis. So I would love to get through NVIDIA earnings and then trade what's in front of us. In other words, buy the rumor of the news, buy the rumor and sell the news.
Sell the news. Got it.
Post NVIDIA earnings, post ARM IPO, and then have this growth rotation, which means lower, into value for the end of the year. So I think value will fall less than growth, long story short.
Got it.
For second half.
Let's talk about what actually constitutes value, Samantha. Let's get really specific on some sectors here. Is banking a value sector right now?
No, I don't like that one. So, so even though there are insurance plays within financial services, I like very, very much. They benefit very much from a higher interest rate environment. No question. Love those. Those are on my trend portfolio for clients. I would chase a swing and a trend, and those are the ones that are absolutely benefiting from this macro backdrop. Banks otherwise are not, and it has nothing to do with Moody's and S&P Global, downgrading. It just has to do with they're not at all viable for me right now as a trend. Swing, you can go long and short, but viable as a trend, given the massive unrealized losses in Treasury holdings that are only getting worse. I know they're backstopped, but again, I'm going to pick my favorites. Energy is absolutely my favorite.
Okay.
And not as what I had called it in November of 2020 through November of 2022, oil as an inflation hedge.
Mm-hmm.
That was a fabulous time to diversify into oil and gas. But this is different. I actually think that the higher interest rates go, the more deflation comes into play of commodities. So the point is, with value holding in energy, it will go down less. Materials, it will go down less. Industrials, it'll go down less than growth. And by that, I mean, especially companies that are tied, really strongly tied to things. So assets that are actually performing and are earning interest so that they can help offset liability costs, as well as commodities. Commodities aren't going to go away. We are going to have a resurgence, I think, in certain core areas of commodities, like, believe it or not, coal. But the point is, I think we're going to have more value in the energy, the materials, select financial services, and industrials. So I'm much more keen on that group than I am on mega cap tech into the end of the year.
Let's unpack industrials a bit more, Samantha. It's a massive sector.
Yes.
Right, and different parts of industrials are exposure to very different end markets. You've got parts of industrials highly exposed to ag. You've got other parts of industrials highly exposed to petrochemicals. You've got other parts of industrials highly exposed to manufacturing. So break that down for us some more. Within industrials, where are you seeing value most pronounced on the horizon?
In the past, we've been able to really look at China as the largest marginal buyer of commodities and tie kind of our boat to that wave. I don't think that's as strong anymore. And I'm definitely not in the camp that China's just going to give sway. That's not my baseline bet at all. But it does mean that they're not as this trade relationship that we have and their buying of commodities en masse is petered out. So we're kind of focused inward. In other words, we're ring fencing. What can we do here on this continent and in this and this part of the world? And I think those industrials that are more, I hate to say diversified, but a little bit of the manufacturing and the energy tied to core. I've got a whole list actually, but they're not tied to China. Long story short, it's about our own reshoring here and our own manufacturing here, capex and development, and again, those with good balance sheets. But they're in a sector that I think manufacturing is oversold right now. Mm-hmm. We've kind of had to go through a lot of digestion here where services were carrying the weight. But right now, I think this is going to be actually a select few on the industrial side. And they're not tied to China, but they are tied to core commodities and things and can benefit from the higher rate environment.
Let's talk then a little bit about the auto sector, Samantha, because there are lots of puts and takes in that one. Where do you stand on the Fords and the GMs relative to the Teslas and the EV titans? How are you thinking about that intersection, that sector it is the intersection of the consumer and the industrials and a lot of the commodity exposure you've talked about.
Yeah, for me, it was more focused 2 years ago on O'Reilly and other plays that were very much focused on car repairs, people trying to keep their cars longer. And again, the cost of that, would they be able to pass on those higher costs? They have been able to. So they've actually been kind of on the specialty retail and the auto distribution sector, not on the end client space. I just see that as very, very, very messy. Toyota was a fabulous play, not just because of their EV concentration, another production they announced, and it was fabulous, but they're also in Japan. And Japan's kind of having a resurgence, right? They're having inflation. And some assets tied to that are doing extremely well. The Buffett bet. So Buffett went in and, took some percentage of ownership in the 5 largest trading houses, which is tied to this, the end of low bond yields in Japan and rising inflation. Mm-hmm. So I think they're able to right now benefit. I think Japan's actually, and stocks that are tied to Japan are much better off. So for me, it's Toyota over Japan, over GM and Ford. And the EV space, because it's so dominated by China, to me is just a trade. It only pops and then drops. It's very, very unsure of itself. And I don't have any interest in, concentration risk in that section. Again, it does not have the profile that I like for a macro backdrop where you have value, but you're also working with inflationary assets that can benefit versus ones that can throttle.
Let's round out the conversation, Samantha, by talking about the consumer. We can't talk about all of the trends that you've just laid out. You talked about car repairs a couple of years ago, as opposed to new car purchases. Auto loan delinquencies are reaching, or have reached actually 2008 levels at this point. That is indicating some stress on the consumer. We saw the Macy's executive team talk this week about how delinquencies amongst their consumer products, financial products suite has gone up and actually unexpectedly quickly. On the flip side, you talked at the beginning of this conversation, rightly so, about the strength of the labour market and how we are seeing wage stickiness. So we're seeing, I think, fairly mixed signals around where the US consumer's health is right now. What is your diagnosis? If you put on Dr. LaDuc's hat and you wanted to diagnose the US consumer, what's your assessment right now?
I would say a little bit of a borrowed time, unless you're tied to real estate ownership versus rental. In other words, our greatest inflationary assets for most Americans is, in fact, our home.
Yeah.
And that has held its, I'm very much not a housing bear. I am a housing bull. So for me, it's all about this theme that I had in summer of 2020, which is things over paper. That basically bonds were done going up because interest rates were done going down. And so tying, your fortunes, so to speak, to things that are very tangible, hard assets, and that would benefit from a higher rate regime has been extremely profitable. So part of that is energy, part of that is real estate. I don't think that's going away. By the way, that's part of the value rotation. I don't think it's going away. I think it's actually incredibly oversold. In other words, they freaked out and dumped it, and now they're like, wait a minute, it's not done anything in 3 years. That's giving some of these REITs time to kind of repair, and commercial real estate as well. But as it relates to the consumer, it's bifurcated. You know that. The fact that we've got a wage inflation is helping the consumer. Nominal wages are higher for increased demand and spending, which is helping the economy. It's helping the companies pass on those higher prices, which then help the earning reports. So all of that's fine and dandy until unemployment spikes. That's a big, big, big deal. And I've got jobless claims, a particular level above 267,000, and we may hit that just on a revision. They're talking about a very large revision coming in that could rework that prior 6 month of jobless claims. And if we get above that level, it's actually going to indicate more weakness in the employment picture, and that could pull recession forward. And you know what happens when we finally get to that place, whether it's wage spiral narrative or it's actual jobless claims and percolating higher unemployment rate, it's very, very hard to put that genie back in the bottle. So they typically pull forward the recession risk. That's the narrative. And then companies start making big decisions based on their outlook. So that's more of the consumer right now is in a sweet spot, for lack of a better word, until the economic backdrop, in fact, does land. Right now, we've had no landing. They're still predicting hard, soft, whatever. But right now, we just, we're coasting. And I think that's a really good place to be versus the alternative. So I think we'll start to see some digestion in 2024, but I don't actually see recession until like 2025. So I think we have some time to digest and for consumers to kind of prepare. I'm hopeful on that.
We're going to leave it there, but I've got to tell you, Samantha, to have guests willing to make bold, specific prognostications. You've thrown a couple. You've looked into your crystal ball. You've thrown out some really specific ideas on timing and levels there. I thank you for that, and thank you for sharing those perspectives with the public community. Again, it's not often, you're a rare guest that's willing to do that, and always come back. We'll see how they pan out. We'll debate what's hit, what's gone differently. That the world doesn't deliver in exactly a linear fashion, as we know. But folks, this is it. This is Leading Indicator, a source of insight from the world's best macro minds, with huge thanks to Samantha LaDuc, founder of LaDuc Trading, for joining us today.